Ladies and gentlemen, welcome to Note Expo 2020. Now here's the founder of Note School, your host, Mr. Eddie Speed.
Well, hello everyone. This is Eddie Speed. It's very, very important of the state of the industry that I have this year. Of the 7 prior state of the industries that I've done for Note Expo, I don't think there's been any year or any situation that's more critical than the one that we have this year. Why? Because the state of the industry this year is about opportunity. I Googled opportunity. In fact, it said opportunity, a set of circumstances that makes it possible to do something. We're going to talk about what I believe is a terrific opportunity in a not well-traveled market. That is what has been in my 40 years the best situation. Finding a situation that's a niche that not a lot of people are chasing and that you have a clear vision of how to go chase it. Now, a couple of years ago, I started focusing on helping real estate investors buy properties on terms, meaning that the seller of the property would carry some or all of the financing. Now, in order to do that, a real estate investor needs usually some equity. They have to have a motivation, a pain. And I found generally that they weren't desperate for money. They were desperate to solve a real estate problem. Now that's been a successful endeavor for us, helping people be able to do that. But this year, that situation has been highly, highly enhanced. Now they say there's 2 reasons that people are likely to respond to an offer: hope of gain, fear of loss. I would say that hope of gain, fear of loss factor, by the time we finish this presentation, is going to be absolutely critical to the process. So, where is it of all of the property owners that has the greatest degree of impact that most people really don't see or don't really quite know the level of the impact? I found that to be landlords. So let's look at a landlord ownership map, and let's look at this grid, and you're going to find that small landlords dominate the market. As you see, the first one of 23 million residential rental properties, 72% of those are owned by who? Individuals that own the property in their own name. They didn't even form a trust or an LLC or the things that probably you and I would do. They're hobbyist investors. They own the property in their individual name. Secondly, limited partnerships. Well, they represent about 16%. Then other represents about 10%. And a very small percentage of the market in REITs or some other corporate entity is just a sliver of the market, about 2% of the market. So about 400,000 properties. Now, we've identified that the small investor, and you can fairly much assume if they own a rent house in their individual name, they're not terribly sophisticated, right? They bought these properties, and now what did they decide to do with them? Well, they decided to self-manage them. 14.3 million of these small individual owned properties are self-managed. In fact, cumulatively, only 4.5 million have some form of professional management. And some of those are even where they formed a corporate entity to do it. But the dominance here is the small investor, 1 to 5 units. That's the process. 1 to 5 units is what they own. The small investor owns these properties. There's about 14.5 million of these properties in the market. So what about equity? One thing that I've learned, if people are willing to seller finance me on my terms, right, they're going to carry favorable terms for me that essentially I dictate to the seller. But having equity is magic. So let's take this group of small investors, this group of about 20 million properties, and let's look at who has leverage and who doesn't have leverage, who essentially paid cash. So now we look at the graph here on that, and we see that 10.3 million properties, literally 60 million of these properties were bought with free and clear cash. Meaning that obviously only 40% or 6.7 million properties was bought with financing. No, the story's getting better. So we've identified a small-time real estate investor. They own 1 to 5 properties. Now we've identified that they own it in their individual name. Oh, and now we identify that they don't have a mortgage 60% of the time. You see, this crisis to come, this real estate opportunity to come, this is different than 2008. 2008, we saw most people occupying the property that got in trouble that really didn't have any equity. Here's a landlord who has tons of equity, self-manages, and so the next question is, well, how well is he doing? How well is he self-managing? Well, let's talk about that. The asset classes and who owns what. Now, a lot of people will say the hedge funds dominate. Wall Street owns all the single family houses. We found out statistically that's not true. Literally, that's not true at all. They're not even in the millions. So understand that the Wall Street owned single family houses are just a sliver of the market, less than 1%. But what do they own? They own Class A properties. That's pretty much that's the asset class they own. Now, there are some small investors that also own the Class A single family house, but clearly this is Wall Street's desire to own this asset. Who do they rent to? Well, they rent to a millennial that can't qualify for a mortgage. They rent to somebody that is 35 to 50 years old that can't qualify for a mortgage. I wonder if they could qualify for seller financing. And the second thing is they rent to people that are older, that had a house and sold it and just haven't gone back out in the marketplace to repurchase and may not repurchase. They're more suburban houses. They're not necessarily urban. But then there's the Class B. So obviously it's not quite as fancy. And then obviously you go down the line with Class C and Class D. Now, I would be the first to tell you that Class D may not make a good seller finance candidate, right? So I'm not saying that every Class D property, because it was a rental in a Class D situation, makes a perfect candidate for seller financing at all. In fact, I'm going to say to you that I'm going to exclude a fair percentage of the Class D properties for that very reason. So the small landlords own some Class A's, predominantly Class B and C, and obviously they own some Class Ds as well. People that tend to be more seasoned have bought more of the Class D properties. Okay. Is Wall Street the giant in the market, in the rental space? Absolutely not. Here, in fact, here's a list of like the top 8 owners. Now, as you see, Invitation Homes, and those are thousands, by the way. So they own 80,000 houses. American Homes for Rent owns 53, and Amherst, and you can see it on down the line. But take number 8, right? Vinebrook only has 3,000 houses, and this is what people talk about. Oh, Wall Street owns the market. Well, those are stats, and this is the information. Wall Street doesn't dominate. Who dominates are hobby, small-time real estate investors. And the truth of the matter is, they have become a label in our business. And what is that label called? A burnt-out landlord. That burnt-out landlord is absolutely, positively a motivated seller. They didn't like managing their rentals before the virus. And let's talk about what has happened since the virus. So rent slippage definitely has, the small-time landlord has been drastically affected in rent slippage, and that situation still continues today. Let's look at it. So this is rental property, and you see that they don't even list Class Ds, but they list class A units, B units, and C units. And let's just start with B units, okay? So we've seen a slippage. They're less at 90% of collecting rents. And on class C units, look at there. On class C, they're at 83%. So this is a dramatic change in the market. Another thing that happened is that the continual slippage of rents has gotten worse. Rent Tech has clients of almost 200,000 rental property, small-time rental property owner clients. They're a software company. And this is their continual decline in rents as the virus has continued. What does this say to us, and why does this matter? What it says to us is the pain has gotten greater. Once again, the burnout landlord, which we estimate to be 30 or 40% of people that own rentals. Can you imagine? They own 3 or 4 rental properties. They watched HGTV. They thought it was going to be great. Everything was going to be fun. And all of a sudden, then they found out now they've owned these things a few years, and it's the job they didn't want. And then quite honestly, it was a job they weren't trained for. They're not competent in. I run in a circle of a lot of high volume real estate investors, right? I'm in masterminds with a number of them. At Note School, I've had at least 200 or maybe 300 of them that have attended Note School over the last couple of years, right? So I'm very accustomed with seasoned veteran residential property managers. Now they report their slippage isn't anywhere near these stats that you've seen. And they insisted, well, these numbers are just wrong. No, why? Here's what I believe the real story is. The numbers are not wrong. The situation is the professional trained landlords that manage the units correctly have experienced above normal performance. And I believe that the hobbyist landlord, the amateur guy at collecting a rent and vetting the tenant and doing all the things that landlords have to do well, I believe he's experienced a below average performance, which means pain. So let's look at kind of where the market is. And so this is a good chart here that shows us 3 things. And we're not going to talk a lot about student loans, but I'm telling you, this student loan thing is an epidemic. I mean, if we're paying attention to the whole economy, this student loan thing is a crisis. So let's just look at it and see really where we are and what might change our situation. So if you look at the missed payments, 1 missed, 2 missed, 3 missed, and 4 missed, you see a pattern. In other words, the tenants and the people that missed their mortgage rent in the 1 payment versus the 4 payment category, those bars are fairly close to the same height. So bars missing Q3 payments, 3.37 million borrowers missed September mortgage payment. 3.37 million, right? 3.5 million borrowers missed their mortgage payment. And $9.2 billion missed their rent in Q3. $9.2 billion in missed rent. So 11% of the renters missed 1 payment, 4% missed 2, 2.8 missed 3, and 3.8 missed 4 payments. We can bury the data to death. This defines a market segment that is screaming for an opportunity. Now, I have included some mortgage data because I think that is critical to the process. So let's talk about a third piece of inventory. One thing we've defined is that people that didn't make a mortgage payment that are in forbearance. Okay, so people that are in a legal contract that says they are not supposed to make their mortgage payment, about 3.5 million. Okay, that's an important number. Now we've said, whoa, there's a gigantic number of people that haven't made their rent, over 2 million, right? Now let's include a third number. The third number is a different category than loans that are in forbearance. These are loans that are severely delinquent, 90 plus days delinquent, but they're not in a legal forbearance agreement. That's another number, right? So you can see the chart there and you can see how that progresses. So here's basically to pull it together just so you can easily see the numbers. 8.5% of renters, that's 2.8 million households, missed, delayed, or reduced a payment in September, according to Mortgage Bankers Association. And 7.1%, that's 3.37 homeowners, are in forbearance. Oh, remember, there's a third category. The third category is estimated at 4.5%. That's 2.1 million people that have a severely delinquent mortgage, 90 plus days delinquent. They're not in forbearance. So you have loans that are not paying in forbearance. You have loans that are not paying that are not in forbearance. And they're fairly close to the same amount, right? Total this up, you have 7.75 million total mortgage or rental payments in the month of September. Now let's go back down history lane for a minute, right? In the last crisis of 2008 and the years to follow, in the last crisis of 2008 and beyond that, everybody in my business, everybody in my world developed a term that became the guiding light to determine when we were going to get out of this thing and how deep the problem was. The term that was used was shadow inventory. And that shadow inventory, my friends, is not reflected in the shortage of houses that are listed on the sale on the market today. This shadow inventory is inventory to follow and shows you where our market is and really the true force of things. Now, at the end, I promised you, I'm going to show you an opportunity. But if I don't show you where the opportunity is, you're not clear as to how to guide yourself, right? 7.1 million, 7.1% in forbearance, 3.37 million. Then you've got your renter slippage in payments, in rent payments. That's another 2.8 million. And then you've got your 90 plus days delinquent, another 2.1 million. That combined, that shadow inventory of people that did not make a payment this month is almost 8 million households. Significant? I'm saying very significant, and something that we need to pay attention to. But herein lies our opportunity. Look at the gray. Look at the 4.5% out there, and you start realizing really quickly that you have 2.1 million distressed landlords that didn't like the job before the virus. They surely don't like the job after the virus, and they have equity. So the hobbyist landlord, lost as much as $9.2 billion in the third quarter revenue in missed rents. $9.2 billion. Okay, where's the opportunity? Eddie promised an opportunity. Well, here it is. This landlord, this burnout landlord, this frustrated landlord, why did he buy a property? He bought a property as an alternative investment with a long-term expectation of collecting long-term cash flow. So why not turn him into the bank? Why not take that burnout landlord and go offer to buy his problem? Entrepreneurs solve problems. Offer to buy his problem, and all of a sudden you've created the ultimate hope of gain, fear of loss situation for your customer. You stop their fear. Their hope of gain becomes collecting a long-term income on their property and not losing money and getting to sleep at night. That is the most critical part of the equation. So your question to me would be, well, Eddie, how in the world am I going to buy a property from them when they can't go evict their tenant? Well, what we've learned in teaching people how to do this is that, first of all, hobbyist landlords are not highly skilled at anything like an eviction process or even managing that situation. That's generally been what we've learned. And secondly, they are long-term thinkers. They're not short-term thinkers. They bought these properties not as a flipper. They bought these properties to own them long-term. The tenant living in the house and the lack of ability to do an eviction, that's a short-term problem. So clearly you would write an automatic forbearance in your loan to them that you don't owe them payments until you're collecting payments. Now you're saying, well, Eddie, nobody will do that. Well, I beg to differ. I beg to differ. If said correctly, I think they'll do it just about every time. Remember, what are their motivations? Their motivations are to find themselves firing themselves as a hobbyist landlord. That's their highest motivation. So let's talk about who in the world, if you bought this property, what would you do with it? Well, if you bought this property, what you would do with it, in my mind, is you would go sell it to somebody that is a perfect deserving buyer, the perfect deserving buyer in the market. So now let's go look at the mortgage industry and let's look at how the mortgage industry has treated the virus. This mortgage credit availability chart, Mortgage Bankers puts this out, and as you can see, it's tracked all along the way. And as you can look at between January, just look at the bottom of your screen there, in January to March, in the middle would have been February, right? And then if you look at who could qualify for a mortgage, and let's go look at the latest data that we had at the time we did this, which was the end of September. There's a 35% decline in who can qualify for a conventional mortgage. Now, let me say this. If I've ever seen a window of opportunity, a pool of great people that the traditional mortgage banking industry has left behind, this chart shows it. This chart paints a clear picture of opportunity. If I can go buy a property and get the seller to carry, let's just call it ridiculous terms, right? And I pay for their equity over time with very soft terms that a traditional mortgage or a bank wouldn't agree to, then I'm going to go resell it to who? The penalty box buyer. I'm going to go sell it to the penalty box. Listen, he's been put in the penalty box, but let's just be fair about it. A lot of these people are rock solid. They are rock solid people. They just have been left behind in the market. So buying the property from a highly motivated seller that needs their problem solved, many of which have excessive equity, if not all equity, and then reselling the property to a buyer that the mortgage industry has left behind, puts me, the entrepreneur, in the middle. You know, I heard a saying back in the last crisis, and they said that there was a lot of talks and articles every day in our industry about distressed real estate. And I heard a guy say at a conference one time, I've learned there's not really distressed real estate, just distressed sellers. Well, you know, that may be the case. Their distress may be my opportunity. Now, why am I not worried that even if real estate hits a skid, which I fully think it will, right? Not 2008 level, but we're going to see a level. You can't have that many properties that are kind of lurking in the shadows with issues and just be amazed and awed at, well, there's so many houses listed, you know, or there's such a shortage of listings. I believe that's it's been referred to as a dead cat bounce, right? So let's look at this past month's average conventional mortgage loan to value ratio. And that number was 81%. Now, what does that mean? That means the average down payment for people to get a conventional mortgage, the ones that could qualify, that's a Fannie Mae, Freddie Mac loan. The average down payment was 19%. So let me pull this together and make sure that everybody is clear about this. Some of you may say, Eddie, I don't want to be a real estate investor. I'm just a note guy. That is exactly what you end up with, right? And believe me, there's multiple ways to do some kind of a joint venture relationship with a real estate investor to let them work with their real estate end, and you end up with the paper end. You have an opportunity to find and approve and vet the highest pool of available penalty box buyers that we've seen in at least 10 years. You have a high pool, millions of properties, where you have a frustrated property owner that thought he was buying an investment and found out he was buying a business. You got that situation. You don't need to go chase junk. There is gigantic opportunity right in the middle of this that is going to produce for you a window of opportunity like we've never seen. Oh, let me make one more point. Who are the seasoned real estate wholesalers? Who are they selling houses to? Who do they flip their houses to? They flip their houses to these very landlords that we're talking about. We call them HGTV buyers, right? But here's what I have found. I know well over 50% of the top 500 wholesalers in the business, just because of the environment that we're in, as far as the masterminds and the training that we've been involved in. So we're very close to these guys, right? So I'm very certain that I'm saying this right about their market conditions and who their customers are. But when I listen, what they say to me the most is less than 10% of the people on their buyers list ever buy. Why? Why did less than 10%? Because they've already thought they were making an investment and found out they were buying a job. So guess what? They're not out of money. They're out of tolerance. So what else does this list, if you're working frustrated landlords, which is a very, very, very definable list. In the marketing world, this is all courthouse research. So they can pinpoint this buyer. You don't have to run an ad in the newspaper. You can use a rifle approach in many different ways to get right to this customer. Oh, but there's another use for the value of your database. Once you have this buyer in place, what else can you do with them? Oh, they can fund your bank. Remember, they don't want to manage another rental. They want income. They're not enamored with going back in the stock market. They moved out of the stock market because they were tired of the roller coaster. They found that they didn't have a tolerance for something that was more commonly understood, which was rental property. And they need to be taught how to become the bank. And then all of a sudden you utilize all of these strategies to fund your business, and even the seller doesn't even have to carry all of the financing. He could carry half the financing and carry a second lien and have a private, one of these private money lenders that was a former burnout landlord be part of the financing. There's so many opportunities. He can buy notes from you. He can buy partials. He can loan you money against a note. All of these things lead us to why I started out the presentation and I said opportunity. In 40 years of doing this business, I've never had more clarity in a market condition that I see not worked well. This, of what I've seen this whole year, this is the pinnacle of opportunity. I want to tell you one more story before we close. I've been married for 38 years. I got 3 grown kids. All 3 of them are involved in our business in some way. Now, that doesn't mean that that's exclusively what they do, but it's part of what they do. So raising the kids, my wife would send me to the grocery store, and she'd give me a grocery list, and I'd have, 15 or 18 items on it. Honey, can you go to the store? Because I've got the kids, or one's sick, or what, you know how it is, right? Well, I was never really great in the kitchen. In fact, I'm not great in the kitchen now, but I'm a little better than I was. She'd send me to the grocery store and she'd list off things, and I wouldn't even know what that was. I wouldn't know what kind of cheese that was or what kind of spice that was. I wouldn't even know it was a spice, right? And she would laugh at me when I would come home, because I would come home just exhausted 2 hours later after I'd gone up and down the aisle of everything in the grocery store looking for the same thing. And finally, the 5th time walking down the aisle, I finally figured out what I was looking for. That's how I see some people in real estate. They're not clear about what they're looking for. Now, after I had gone and done these things a few times, I became a lot more efficient at going and finding things, as long as I wasn't looking for something new that I'd never gone after before, right? And then all of a sudden, I became accustomed to the trail, accustomed to the turf, accustomed to how the store was mapped out and where to find things. So what I found is the pattern, because of the people that show up at our doorstep literally every week, the pattern of the burnout landlord, the pattern of them having the property that they're willing to carry financing on, the fact that they're also willing to fund money in our deals because they don't want another headache. Understanding that process is a clear map to me today. I hope it has now become a clear map to you. Be safe. God bless.